Around here, they say there's only three guarantees in life: death, taxes, and the need for a snow brush all year in Alberta. But what some people don't realize is how much our loved ones will have to pay in taxes when we depart, and how big of a chunk the government could potentially take.
Is who do you want to be the primary beneficiary of your estate? And it's going to be your loved ones, your favorite charities, or the government and Revenue Canada. Okay? So very few choose that third option. But by not having your beneficiary set up the right way on your accounts, you are by default potentially making Revenue Canada your largest beneficiary.
Certified financial planner Tina Buckthorpe sat down with Unison TV to talk about fun stuff like death and taxes and how to avoid mistakes that could end up costing your loved ones time and money. But first, she shares her story about how the absence of a will impacted her own family.
Personal situation of my own is when my biological father passed away. I was ended up being part detective for figuring out where he had a few accounts. And I discovered a small account with one of the big five banks that a very small pension payment was going into. This account had under $1,000 in it. And the hoops that the bank made me jump through. I have one biological sibling, so my brother lives in Australia. They needed him to sign the documentation also before they would release this small amount from the account and close the account. He didn't leave a will. And he'd been sick a few years ago, and I had asked him at that point if he had one. And of course he said no, and didn't bother putting one in place before he passed. It really turned it into a more onerous task for dealing with the affairs. Yeah. And as my friends were saying, at least I knew the steps that needed to be taken.
So, Tina, what are some of the important things we should know about beneficiaries?
So let's take a look at things like your RRSP account. The RRSP, Registered Retirement Savings Plan, needs to be converted to an income fund, the RIF, by the time you turn 71. On that account, you can name who the beneficiary is, whether it's the RRSP or the RIF. You can have a named beneficiary. If you have a spouse, common law, same-sex partner, doesn't matter. As long as it is a spouse, so a spousal arrangement, that money can roll over tax-free to your spouse. If you do not have a spouse, either your spouse has passed or you've divorced and no longer are in that relationship, then quite often people will put their children on the RRSP account. Now, unless the children are under the age of 18 or they've got a disability of some sort and are deemed dependent children, unless they fall in one of those categories, those funds are going to be 100% taxed as income on the day you die, and the government wants that income tax before your beneficiaries receive anything. So remember, when we put the money into the RSPs, we get a tax break. Ideally, we're putting that money in when we're in a higher tax bracket, and we want to take it out when we're paying less taxes. But say you've saved diligently and you've saved over $250,000 in the RSP funds. Now you pass. That puts you in a high income tax bracket. And depending on which province you live in, the government's going to be looking for anywhere from about 45% to 50% of those funds as income tax before your beneficiaries or your estate receive anything.
Have you seen that happen?
All too often. is that people are not realizing that they lose that tax sheltering. And it's a big consideration. So that's something I've worked with a lot of clients on, is how can we minimize the amount of tax that their estate is potentially going to need to pay down the road. And for some, that strategy may involve drawing more from those registered funds while they're in those earlier stages of retirement, and making sure that we balance the withdrawals so that we don't take their income up too much and end up increasing the amount of tax that they're paying by too much. But we draw some excess out and continue to save in the tax-free savings account. So making the most of the tax-free savings account, the TFSA, because that is a gift that we do have from the government. The TFSA is tax sheltered, so the income you earn, you don't have to pay any tax on. Those contributions, you put that money in there. Yes, we're allowed to put in $7,000 a year as the maximum contribution right now. But if you have not maximized your contributions from the time the plan started, then you've got carry forward room and could potentially put additional funds in. And with that, those funds will then roll over on a tax-free basis to a spouse, as long as you've listed your spouse as the successor annuitant. Then that will roll over and they can combine the funds with their own TFSA without any tax consequences. If you have children or other loved ones named as beneficiaries on your TFSA, then when you pass, the funds will be paid out as cash to your beneficiaries. And then it's up to them as to how they invest it and whether or not they're able to tax shelter those funds.
So does the TFSA, it'll always be a tax shelter? Nothing changes when you reach a certain age with that?
Correct. As long as the government doesn't go changing the rules, which is really hard for them to do on an existing plan. They can change the amount of contribution that people are allowed to put in, but it is a vehicle that we have to use. So I have had people take more from their RSP or RIF, have enough to live comfortably, and put some surplus into their TFSA. That way we're bringing down the balance of the highly taxable RSP or RIF account and putting money into the tax sheltered account. And they can use that whenever they want to. They don't have to claim it as income when they take money out. So that's a way to balance things too, to make sure that you don't increase your income to the point where you start losing benefits, is that you manage the amount that's coming from your pensions, your OAS, from your RRSP or RIF account, and then draw what you need for maybe a car repair or a trip from the TFSA account.
And do you have any advice on what rate people should be doing that from their RSP?
I don't go by a set percentage rate. I go by, running the numbers through the financial planning software and then assessing what is the best situation, the best solution for the individual household. Make sure that you get a financial plan put into place so that really highlights where the numbers are at. And there are financial planners that, if your investments are with a bank, then the bank may have a financial planner who could run some numbers for you. Or you can engage the services of someone like myself who does plans on a fee-based arrangement. And there will be a cost involved, but I typically save clients thousands of dollars in regards to the long-term tax planning.
And what about RESPs? What if your kids didn't end up using all the money you had saved there?
Okay, if you've put funds into an RESP and the children did not use all of the funds, if you have contribution room available in your own RRSP, you can roll the funds over into there.
What if I don't have room in my RRSP?
Then it is going to be taxable. There are going to be tax consequences for pulling the funds out, the government is going to take their grant money back.
Mhm.
Yes. So ideally, you have your children use the funds, and the rules were changed years ago so that if you have more than one child, if one of the children does not use all of the funds, their siblings can use the funds. Even though you're thinking you're making a contribution, okay, I'm putting in this much for John and this much for Kate, and John used all of his, but Kate didn't. Well, that money doesn't have to not be used for education purposes.
Mhm.
Say John decides he's going to go for, he's completed his bachelor degree and now wants to go and pursue a master's.
Yeah.
Well, those funds could be used, the siblings' funds could be used to help with his education costs.
Well, let's say the kids don't end up using all their funds and you don't have room for contributions. Is it fair to say that you're just out of luck?
Unfortunately, there's going to be tax consequences.
Yeah.
Okay, you can get the money out,
Yeah.
but the government's taking their grant funds back.
Anything else? They're taking
And you will be taxed
on
on
that.
the investment income that has been earned within the plan. The amount that you put in as straight contributions, that's your money, you get that back. But the investment earnings are going to be taxed. For the beneficiaries, it's really a case of thinking about who and how you want those funds to be dispersed. And if you've named children, I've also seen scenarios where a parent has put one child on their RRSP and a different child on the TFSA, thinking, well, the accounts are similar balance and they could each have one of the accounts. That doesn't work because the RRSP or RIF funds are taxable, where the TFSA will just be paid out.
One kid's not going to be pleased.
And that's right. It is not going to be the equal distribution that you thought it might have been.
Okay, it's good to know.
Leaving funds to a charity is going to provide some other benefits because that charitable donation on death, that will provide your estate with some tax benefits from that donation. So you will get donation credits from doing that, and that could potentially help offset some of the tax bill that the estate may be facing. And so if you do not have children of your own or a favorite niece or nephew that you want to leave funds to, then yes, think about supporting your favorite charity. And that way, your charity will benefit and Revenue Canada will get less. There's many that I have seen and read about where there's been a cottage in the family, a recreational property, and the family didn't take into consideration the capital gains tax that would apply to the eventual sale of the property. And if you have a situation where the parents pass, they roll the family cabin over to their children, but the children aren't all using it now, and so a decision is made to sell it, the capital gains taxes could be significant.
So what's the solution for that? Like, should you be selling off your second homes or properties so that you can avoid that tax?
That's always going to be an it depends scenario on the individual situations. You need a good family discussion with that. Are the potential beneficiaries wanting to keep that property, or should the parents be looking at divesting it before they pass? How long do they want to keep that in the family? And if it is something that they potentially want to retain, is there potentially benefit to put it into a family trust? Maybe that's an option to consider. There's going to be capital gains, and there's always a deemed disposition at a minimum of every 21 years, right? So there, you can't avoid the taxes forever, but it might be a way to help manage it in more bite-sized pieces along the way. Now, something else that, depending on the age of when people are reviewing this, is if you know there's going to be a large potential capital gains bill, is take a look at having insurance coverage to cover the tax bill.
What's that mean?
Take out an insurance policy for the amount that's going to be needed for the taxes. And that could be a much lower cost than what the tax bill would be.
What's that called?
And,
Is there a name for that? I've never heard of that.
it's just insurance. And I'd put a permanent life insurance policy in place, not a term life, because you don't want a term policy that expires at age 70 in place and you pass at 75, then without the coverage. And assessing what the potential tax liabilities are for the estate. If the individuals are healthy, for starters, and depending on age, because as you get older, or if there's health issues, then you may either find that due to age, the insurance premiums might be more than you want to pay, or due to health issues, you may not be insurable. So those are always factors to look at an earlier stage, and covering that potential tax bill. That then gives your family peace of mind that they aren't needing to look at having a fire sale of the property in order to pay the tax bill. Because that's happened too, is where people are forced to sell that recreational property that they wanted to keep in the family, but they can't because they can't afford the tax bill. And the only way to pay the tax bill is to sell the property.
Ouch.
Depends on individual households. And, if it's a cabin that's been in the family for 3 generations and there's, sentimental attachment to it and the family wants to hang on to it, then you're looking for the ways to retain that property. And the other factor being is none of us get to choose our exit date. We don't know when that's going to happen.
Yeah.
So the advanced planning needs to happen while we're alive so that the family isn't trying to figure out what they can do when you pass.
Yes.
Yep. And one of the key steps is making sure you have a will in place. Because without that document, there's a lot of red tape and hoops to jump through in order to deal with a person's estate. The full discussion of the estate plan should happen because you want to make sure that how you've lined up the beneficiaries on your registered accounts is in line with what you've put out in your will. Okay, there's been instances where people have said something in their will and then the beneficiary setup contradicts, and always needing to look at family dynamics. Is it going to be straightforward with the family, or is there potential for someone to contest a decision that you've made? I know of an individual who, when his father passed, he knew there might be some dissent within the family, and he had them all sign an agreement before the will was read that they would not contest, that they would accept the decisions that were documented, or they would potentially not receive anything. They had that conversation within the family, and everyone agreed before the will was read.
That seems like a good idea, especially if you know your family is a bit
depends on
troublesome.
family dynamics. Family dynamics, they can be challenging, and you don't know what's going to come out once you pass. Regardless of the size of your estate, you want to have the will in place. And we still find that over 50% of Canadians do not have a will. No, even a small estate. The first thing somebody passes, and you find out where their bank account is, and you go to the bank, and you've got a copy of the death certificate, and the bank's going to ask, do they have a will? And if you don't have a will to show them and give them a copy of, then they're going to want to, who are you for dealing with this estate? And even if it's a small matter, then maybe they're going to say, well, no, we want you to go through probate and have the courts grant you administration rights on this before we're releasing any funds. Depends on the size of the estate. Look at, in the headlines when Prince passed away, musical artist, right? Large estate, no will. People who were coming out of the woodwork saying, "Oh, I'm a relative." Yeah, and wanting a piece of his estate.
If you're a prince or a pauper, make sure you do the planning and have the knowledge, because not planning can leave behind taxes, confusion, and snow in your windshield if you don't plan for that June snow. For Unison TV, I'm Carolyn Curry de Castillo.